Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. It is no secret that interest rates are high, making some buyers hesitant to purchase, and a lot of investors concerned about the future. So, what can you do about it? Today, we're going to spend some time looking at alternative lending options when you find yourself in a high interest rate environment on the Real Estate Guys radio program. All aboard! Registration is open for the Real Estate Guys 22nd Annual Investor Summit. Imagine spending more than a week with like-minded investors, world-class educators, and real-world professionals. Returning in 2024 is the editor of the Gold newsletter, Brian London, real estate developer Beth Clifford, and the rebel capitalist George Gammon. Back with us in 2024, sales legend and best-selling author Tom Hopkins. And joining us live and in person for his 12th Investor Summit, Ken McElroy. Plus 2 brand new faculty members we can't even mention yet, and a lot more. It all begins June 13th in Fort Lauderdale, Florida. Visit investorsummitatc.com to get all the details and reserve your spot. This transformational week is like no conference you've ever attended. Go to investorsummitatc.com and make plans to spend a week with the Real Estate Guys, Ken McElroy, Tom Hopkins, and an all-star faculty on the 22nd Annual Investor Summit at Sea. Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms, and joining me in the co-host seat, our financial strategist, Russell Gray.
Hey, Robert.
Big part about acquiring rental real estate is the financing, and it is no secret to anybody listening that interest rates are up. They're way up. They went up quickly, and it is impacting the market in a huge way. We see home builder sentiment down. We see rents are slowly working their way up. They're stagnating in some places, and yet for many people, what you have to pay every month to finance a property is literally twice what it was just a year and a half ago. So that is the elephant in the room, and today we've got some hope for you. We're going to talk about some alternative lending strategies and options that you consider when the rates are high.
Yeah, it's not just rates, which is one part of the equation, but it's a willingness to lend. And banks' balance sheets are in trouble. It's no secret Silicon Valley Bank is probably the most notable of the banks that failed. But any banks holding long bonds in a rising interest rate environment took a big hit to their balance sheet. And even though they might have some profitability, the banks have been coming out with record profits, but really increasing their loan loss reserves. And so the word on the street that I'm hearing from people in the lending business are LTVs are going down.
Yep.
Coverage ratios are going up.
Yep.
People are hesitant. Their buy box or their lend box is getting tighter. And so, as our good friend George Gammon says, it doesn't really matter what the interest rates are if there's no appetite to lend. On the flip side of it, there's the borrowing. And part of the borrowing that goes on in the economy is a seller who's got a property who wants to move to another property, puts that property on the market, and then goes and gets a new loan and transfers the equity to the new property. Or in some cases, as a lot of investors do, they harvest equity from property A and use it for down payments on property B, C, and D. Those things all work when the interest rates are fairly stable, but right now you still have the impact of the rising interest rates bringing prices, should be putting downward pressure on prices, but the lack of inventory is compensating for that. So it makes it really difficult. And I guess the point is the last time we saw interest rates spike this dramatically, not quite as much in terms of percent of change, but certainly in terms of shocking the system, was in the early 80s. And that was really the birth of creative financing. And this is what happens when you can't just go down and get what you want off the shelf, if you will, from the lending institutions. Then you've got to find creative ways to get deals done. And we're starting to see more of that come. So we're going to be talking about some of that stuff today and maybe some things you haven't heard of before.
It's one of the reasons you want to listen to a couple of older guys that have been through all kinds of markets up and down and sideways. And I think you're going to hear some things today that maybe you haven't heard before. And it's like a smorgasbord. Pick and choose what might work for you and what might not. The last thing I'm going to say in terms of all the bad news we're delivering is there's an excellent chance that interest rates aren't going back down. There's an excellent chance. So many people are just waiting until the rates go down. Well, you know what? They may not. And if they do, they may not go down very much. I personally don't think we're ever going to see 2 and 3% interest again. I think that was an anomaly. It was an anomaly for 10 years, but it was an anomaly. And we are now in more of the normal territory. I've shared on the show that Kenny McElroy and I have been investing about the same amount of time in real estate, and he brought this to my attention. He goes, Robert, during the time you and I have invested, the average interest rate has been higher than the current interest rate. So if you've only invested in the last 5 or 10 years, you think rates are sky high. If you've been investing as long as we have, you think, this is what they do. So let's focus on the good news. Here's the good news. Real estate leverage, borrowing some of the money, no matter what it costs you, is an awesome way for you not to have to come up with all of the money. And that leverage helps you long-term own an asset that, one, is likely to increase in value, 2, provides cash flow that is likely to increase, 3, can provide tax benefits, and 4, your tenants pay off your mortgage. Yeah, that mortgage that you're worried about getting over 15 or 30 years, if you just hang on to the property, you don't make that payment. The tenant does. That's all the good news. And sometimes people lose sight of that. They think, well, rates are so high, I'll just sit it out. Well, I started in real estate. My very first property, my loan rate was 10.25%. If I had decided to sit out the investment property game until rates came down to 5, I would have been waiting a long time to have bought my first property. So it's not great when rates are higher. We all wish they were less. We all wish that we had the payments we had 2 years ago. But since we don't, let's talk about what some of the possibilities are. So the first thing is, who's your lender? Right? I mean, today you would be able to go into a mortgage broker or your bank or a credit union and talk to them about making you a loan on a property. And to Russ's point, there may not be as much readily available financing as there once was, but today you still can find loans if you look and if you're creditworthy and so forth. But that's just one avenue of lending. There's lots of other avenues. So I think the first one, Russ, we should talk about is maybe the oldest method that we've seen people use, and that is asking the seller to carry the financing. Since you're the financial strategist, why don't you explain how that works?
Well, it's actually pretty simple, and there's 2 variations of that, because we can also talk about wraps or assuming existing loans. But in this particular case, you get whatever kind of a loan you can get, or you find a property that's completely paid for, and you go in and ask the owner, instead of taking cash, they take payments. And you can calculate what that can be. I've seen people go in and negotiate principal only. In other words, it's a 0 interest loan. People get their price and what they're interested in. When you ask them, what are you going to do with your equity when you move? And they say, well, I'm going to retire. I need a stream of income. What are you planning on investing in? Treasuries. What are you going to get? 5%. If I give you 6 or 7 or 8%, would you like that? And if they say yes, then you cut a deal. If you fail to perform, they get the property back. They know it. They like it. They trust it. So that can be a way. And there's a lot of variations on the theme. But basically, seller carryback is getting the owner, instead of getting a check to cash out their equity, they get a stream of payments.
Now, often you do have a down payment, of course, just like you would with another loan. You might still put that 20% down, but ask them to carry 80%. That's backed by an asset that they know and understand. So that can be a great tool to get the seller to carry it back.
And the other part of that I mentioned is the idea of a wrap. And you've got these folks out there that have these 2.5%, 3% loans. Those are gems. And to get to them, you've got to take out their equity. So just hypothetically speaking, let's say you're buying a $500,000 property and somebody's got a $300,000 2.5% loan on it. You're like, I really want that loan. Well, you need to come up with $200,000 to take the person's equity out. And then instead of them exiting the loan, you wrap the loan. Conceptually, the loan stays in place, and then you take over making the payments. If you imagine when you go to buy a car, you don't get the pink slip until after you've finished making the payments. The way it works in real estate today is if you go get a mortgage, you're going to get the deed. And so they give you the deed and you're the owner of the property. And then you're going to create a trust deed or a mortgage against the property, a lien on the property. So even though you have title, it's encumbered, so you can't sell it without settling the loan. The other way is the way you do it with a car. With a car, you get the registration, but you don't get the title to the vehicle until after you've paid the loan off. And so you can buy a property the same way. You buy the property and you get the title after you pay the loan off. And so in the in-between, you're just making the payments and you're effectively what they call wrapping that 2.5% loan. But in this case, you got to come up with a couple $100,000. That's where you can take the previous topic, the seller carryback, and maybe you give the seller $100,000. They take $100,000 back and you wrap the first loan. So you can put the combination together in different ways. The point is that existing financing is an asset. And if you think, well, why would I want to do that? I can go get a new loan. Yeah, you could, but you might have to get a new loan at 7.5%, 3 times the rate. If you were to do the math on the delta in the payment, you'd realize that maybe you could borrow the money someplace else, or that you'd be well served to make that income payment when you do the blended rate to the seller. You give the seller 8% and you get 2.5%. You put that all in a blender, your total cost of financing this property might be 4.5%, 5%, even though you put it together with 2 pieces. So there's different ways to do it. And the point is, don't be dissuaded, because the other advantage you've got in a market like this, when people only know how to use conventional financing and they can't figure it out, they're not players. You're not bidding against them. They're not in the market. That makes the sellers who are having a hard time selling because there's less people buying more pliable, more open to alternative strategies to getting the property sold.
Well, you hit on a thing, Russ, which I was going to talk about, which is, why would a seller want to do this? Well, the answer is they want to sell their property. And it's always price versus terms.
And get their price.
And they'd like to get their price. So the price versus terms discussion is, if you ask the seller to carry, you're probably not going to negotiate them down too far on the price. In exchange for you saying, hey, I'll give you the $500,000. Here's what I want you to give me. And I love the idea of the 0 interest rate loan. I will tell you that rarely happens, but sometimes it does, because they want their price. They want to be able to tell their neighbors they got their price. They want to be able to tell their mother-in-law they got their price, and it's price versus terms. So there are definitely ways you can negotiate with sellers. A seller that's a don't-wanter, a seller that has a real reason they have to get moving, might be open to this kind of scenario. Now, as Russ mentioned, it usually works best when the seller has a lot of equity. If they don't, then you would consider the wrap. And you may be thinking, well, what about the due on sale clause, which says if the person that borrowed the money originally sells the property, then the note is due? That may very well be true. In most cases, practically, that's not what happens, but that is something to be aware of and at least talk through and get on the same page with the seller. So that's alternative number 1, is a seller carryback, and we'll say 1A is a wrap. Let's talk about method 2. And that is a private lender. So rather than an institutional lender or a bank, there are private lenders. Some people are what we call hard money lenders. They'll loan for a higher interest rate and more points, and that might work just fine. But there's other private lenders that don't make their loans based on anything but the asset value, an asset-based lender. And so sometimes when you're buying a property that has some found equity or some upside or some great potential that the previous owner hasn't been able to glean, you can find these loans that are available. And a couple of things about them. The first is that they're often nimble. You can get these loans processed quickly. It's often a person or a couple of people that make the decision, not some faceless, mindless committee. And it can be a super good tool for the right property.
Well, when you're dealing with private parties, they're not trying to underwrite the deal to fit into some arbitrary box, underwriting guidelines that are going to fit secondary market criteria. In other words, this paper is not going to be traded around the casinos of Wall Street like a lot of paper does. It's going to be held by somebody that actually wants to collect the income, or the flip side is would be perfectly happy to foreclose on the property. So you just have to understand that. Typically, you're going to have a lower LTV. They're probably going to want 35 or 40% protective equity, meaning 40% down payment. You're going to have a lot of skin in the game, but some leverage is better than no leverage. And then it's just a way to get it done. And it can solve the problem of there not being conventional money available, or even in a market where there is conventional money available, if you're not eligible for that conventional money because maybe you don't document so well or you don't have the great credit score. It doesn't really matter, because the lender, just like in a commercial property, isn't really looking at you. They're looking at the asset. They're not even looking at the income on the asset. They're just looking at the equity or the value of the asset. And they're saying, hey, if I ended up taking that property back at 40% off, it would be a good deal for me. So they really don't care. I'm not going to say they don't care if you don't make the payment, but it's not as scary to them as people who absolutely do not want to take the property. So the danger is that sometimes people make those loans with the idea they hope you miss the payment. There's not going to be a lot of grace when you have that much equity available in the property for the lender to foreclose upon.
Yeah, that's a great point. You want to understand what the real agenda is for the lender. And there are some hard money lenders, they're after the property, and there's some hard money lenders that do not want the property. They want to set you up for success. But all lenders have to answer two questions. How are you going to make the payment? And what happens if you don't? And asset-based lenders are more interested in what happens if you don't. All right, number 3. This is a great one. Now, you may be familiar with this and you may not, but when interest rates start to head up the way they have, we see the opportunity for investors, owners, home buyers to buy down the rate. And when you think about the way a loan works, there are fees and points that you pay up front, and there's the interest rate over time. And you can balance those kind of like you do with a deductible on an insurance policy. You can say, in order to get a nice long-term lower rate, I'll pay a few extra points. Rather than pay, say, a point and get a 7.5% loan, you might be able to pay 4 points and get a 6.75% loan. Well, you just have to do the math. And as Russ says, the math will tell you what to do. If you're planning to hold the property for a while, this can be a way to get the rate down. Now, buy downs are in all shapes and forms, and with private lenders, they're really negotiable. But there can be a rate that buys the loan down in perpetuity for 30 years, or there can be a rate that buys the loan down for maybe 3 points in the first 2 years, 2 points in the next 2 years, 1 point the year after that. There's a lot of latitude when it comes to buying down the rate.
So I think one thing to keep in mind is that there are two worlds of real estate financing. There is residential, which is typically 1 to 4 units, a single family home, a duplex, a threeplex, or a fourplex. And then there's commercial, which could be 5 units, 6 units, or a commercial building. The rules in residential 1 to 4 are very different than the rules in commercial.
Yeah.
It used to be, back in the day, pre-Dodd-Frank, that borrowers in residential 1 to 4 could have the option of aggressively buying down a rate, paying a bunch of points up front. That changed a little bit. And so the market has come up with some creative ways to deal with that, which we can talk about in a minute. But before I go there, I just want to make sure everybody is kind of on the same page as far as understanding the concept. So the idea is that when you look at a loan, you've got principal. This is the amount of money that the bank or the lender is giving to the borrower to purchase the asset. And then there's the profit on that loan, which is the interest. It's the risk premium. And we usually think of that as being built into each monthly payment on an amortization table. So I'm going to pay $1,000 a month, and $900 of it is going to be interest in month 1, and $100 of it is going to be principal. And then over time, that ratio changes till pretty soon at the end, it's mostly principal and no interest.
Right.
But the other part of it is when we pay points, there's points and there's fees. Fees are all the fees associated with getting the loan underwritten. So there's the appraisal fee, the underwriting fee, the documentation fee. We call them junk fees in the business. It's just like a big long laundry list if you've ever gone into a closing statement of all these fees. Then you have points, and points are broken into 2 categories. One is the points that you pay the originator, like a sales commission, for generating the loan.
Yep.
The other one is prepaid interest that you pay to the lender. And the lender looks at it mathematically and says, hey, typically a loan, even though it's a 30-year loan, typically the loan's only going to be held for maybe 3 to 7 years. So based on an average, if I collect a certain amount of upfront interest and spread that out over the term of the loan, I end up getting my overall yield on that loan to be higher than the note rate itself. So this is why a lender is incentivized to do it. Instead of having to wait to get their profit, they get their profit up front. The reason you would want to do it as a borrower is because it takes your note rate and drives it down, which improves your cash flow. You get to, if it's a purchase money loan, again, I'm not giving you tax advice, check with your tax advisor, but if it's a purchase money loan, that interest is deductible in the year that you pay it. Not on a refinance, but on the first one, the way I understand it. Again, not a CPA. So there's reasons why you want to do it. You could, and especially in residential, when you're trying to manage your ratios, your debt to income ratio, sometimes you can't qualify unless you bring the rate down or the payment down. And to do that, you need to bring the rate down, and you got a choice. I can put more cash into the down payment, or I can put cash into the rate buy down. And I think if you do the math, you find out it's a lot more cost effective to put the cash into the rate buy down if you can do it. The flip side of it is that because of the limitations in residential 1 to 4 as a borrower, sometimes the seller can do it for you out of their profit. And that's a strategy that we're seeing more and more of as sellers are trying to figure out ways to help people deal with these high interest rates.
In fact, that's going to be 3A, and we're going to cover that when we come back. We're talking about alternative strategies to finance your real estate when the rates are high. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
Are you achieving everything you want in life? What if there was a time-tested way for you to get everything you've ever dreamed of? The most successful people in life set goals and keep themselves accountable. But how? The good news is that it's not rocket science. You too can learn the skills and unleash the motivation that will create success in your life. Hi, this is Robert Helms, and I'd like to personally invite you to attend Create Your Future, the 2024 Goals Retreat, January 12th to 14th in Dallas, Texas. This unique weekend event has been called phenomenal, inspirational, and life-changing by the thousands of people that have attended. Hear from some of them and find out more at goalsretreat.com. Get your life back on track, physically, spiritually, and financially. Attend the 2024 Goals Retreat on the second weekend of the new year. Visit goalsretreat.com to learn more and get on the advanced notice list. This is no dress rehearsal. Live the life you were meant to. Visit goalsretreat.com or call 888-489-7723 extension 18. That's goalsretreat.com.
Hi, this is Sheriff Mack, and you're listening to the Real Estate Guys.
Welcome back to the Real Estate Guys radio program, now in our 27th year of broadcast, approaching year 28. Great to have you with us today. We're talking about alternative lending options when the rates are high in traditional mortgage. And these have been around for a while, but maybe you haven't been around for a while in terms of seeing the market up like it is. What can you do? You can sit it out, or you can find a way to make it a little more affordable. We were talking before the break about buying down the rate, and a lot of lenders will allow for that. The asset-based lenders and private lenders can be more negotiable in that regard, but there's another big subset of folks for which this gets really interesting, and those are developers, people that are building new homes, new inventory, even new fourplexes, can often set up their financing so that they can provide you with what is effectively a buy down. In fact, next week on the program, you're going to meet a builder who's doing exactly that, and nearly 100% of their clients are investors. So it's not just someone who's doing it to sell houses to people that live in them. It's a show you're going to hear. But we are seeing builders offer this kind of an incentive because they can.
Well, you've got their profit margin. And inside that profit margin, from the cost of actually building the property and selling the property, there's sales expense. And so a builder who's trying to sell a property and realizes, hey, I need to make this thing more affordable, again, they can lower the price, just like you can put more down payment in, but that takes a much bigger chunk of profit out versus if they take a smaller piece of the profit and invest it into buying down the rate on the borrower's behalf, you can get a below market interest rate. And of course, if you're trying to put together a deal where you need it to cash flow, then you able to get better cash flow on the property, not because the rents went up, but because your borrowing costs went down. So in a marketplace where interest rates are maybe 7.5%, 8%, you might get a rate, below 6% in these types of scenarios. And you say, well, how did you get a 6% loan? Well, the builder contributed to buying it down. And bigger builders, bigger developers are able to come in and purchase money, if you will, because money is just like any other commodity. And if you buy it in bulk, you can get a discount. They can buy up, if they're well financed, they can buy up a bunch of money and then turn right around and use that to fund the loan when you're purchasing from them. And again, it can be a below market rate because they're making profit on both the property and also on the loan. So there's, again, more creativity. It's not as simple. That's why we're doing the show, right? It's not as simple. You're used to, I'll go make 20% down, fill out the paperwork, they give me a loan. But today, with the interest rates and the way the rents are, and it's just harder for both sides of the equation to get together and do a deal. And so you're seeing these creative strategies come in place. So it's really kind of fun to see builders recognize, hey, I've got some profit in the deal because the prices have held up actually pretty well, but I'm still not getting enough buyers. And so the way I can create more buyers is by creating more affordable financing, and I can put some of my development profit into doing that. So we'll be talking about that next week.
All right. So that's 3A. Let's get to number 4. Talk about a classic alternative lending option, and it is to buy for cash, to not get a loan. You think, wait a minute, that takes away the whole benefit of leverage. Well, that's kind of true, but follow me on this. The reason we like leverage is that it lets us put down, say, 20% and control 100% of the property. And when you've got an interest rate that makes sense and the rents can easily service all your costs and your debt service, you're feeling good about it. But when you have a property that could perform well with no loan, it might be that your ROI on cash could be pretty darn good. We're seeing deals today where people that are buying all cash are making 6, 7, 8, 11, 12% returns because they're not paying interest. Now, interest is deductible, so you got to figure that into the math. Do the math will tell you what to do, but it might be, especially for lesser expensive rental properties, that a great way to buy right now is all cash, because you know what? If the rates do change, if they do come down, if I'm wrong and we see 2% rates again, you can refinance.
Yeah, well, you say all the time that you only get one opportunity to negotiate the price, and many times you can renegotiate the financing depending on the market conditions. And so if you're purchasing in a market where properties aren't selling, cash is king, especially when there's not financing available. And if you feel good about the market, you feel good about the property, you're going to purchase the property, you're going to purchase the income stream, you're going to purchase the depreciation schedule, and all of those things factor into your blender, if you will, when you're calculating your internal rate of return. And then if there's some things that you can do to force equity, fix the property up, manage it well, you're buying in the path of progress. The local market may carry you a little bit. Obviously, to your point, Robert, if interest rates come down and lending opens up, you're going to catch a little bit of a wave because of that and be in a position to benefit. And, you can turn right around and sell the property as an owner carryback and generate a stream of income for yourself if you wanted to. So there's other ways. You don't have to be in the landlord business to derive profit out of that. And the other thing is that when you do the purchase, if you're coming as an all-cash buyer in a tight market, you're probably going to get a better price at the buy. So cash can make a lot of sense in markets like this. And if interest rates go your way, it's a bonus. I wouldn't bet the farm on it, but I'd say, probably 50-50. I mean, interest rates certainly could come down. We've seen them soften a little bit as we are recording this show. So we just don't know. I think a lot of people would have argued that the rate of change, how high it went, how fast it went, I think a lot of people would have bet they wouldn't do that. It would just blow too many things up. And those things are blowing up, and it may get worse before it gets better.
Yeah.
But if you have these tools in your toolbox and you go out in a marketplace where people don't, again, you're going to have a competitive advantage. Cash is not a great place to be right now. If you're sitting on a bunch of cash in a bank account, you've got counterparty risk because the bank is only going to be covering you FDIC insurance up to $250,000 per account. Inflation is running 3, 4, 5%, so you're losing right there. I think could make the argument that real estate, income producing real estate in the right market can be a very safe place if you don't need the liquidity and you need a place to park your wealth. It could be a great way to go. And then again, if the interest rates move your way, then you can have a chance to liquefy. But even if they don't, you can sell or you can carry back to generate either income or liquidity if you need to.
Now, Russ, you made a great point I want to make sure nobody missed, and that is when you have cash, you get a better price. Back to cash in terms. If I'm asking the seller to carry, I'm going to pay pretty close to asking price, if not asking price, if not over asking price. If I'm coming in with all cash and I can close in 7 or 10 days, then the seller may very well be willing to give me a discount. That's one of the great things about real estate. There's not just one market. Every seller's motivation is different. What they're trying to accomplish is different. So cash truly can be king. I'll give you a strategy we used to use a lot. Now, the one challenge with being a cash buyer is Unfortunately, you have to have the cash, right? You have to do that. But back in the day, we used to often write cash offers. Cash. And we would show that we had the cash to the bank to close. But way buried on page 7, we would have a little contingency that says, buyer reserves the right to procure financing for this purchase. However, this financing is not a contingency of this agreement. Meaning that normally if you have to get a loan, you put in the purchase agreement a financing contingency. It says, hey, Mr. Seller, Mr. Buyer, I'm going to buy this contingent on my ability to qualify. And then, of course, you're interested in what is my ability, and you want to see that I've been qualified with a lender and I've got good job history, good income, good credit, and all that stuff. So this was a great strategy to be a cash buyer. And many times we'd been able to swoop right in and get a loan anyway. And the other thing about it isn't just that you'll get a better price. When that rare property comes up that is just a deal or a steal and there's 7 buyers, when you come in all cash, fast close, you're likely to get the deal. And sometimes getting the deal is what's important. We're talking today about alternative financing options in a high interest rate environment. We've got several more to share with you. Plus, we're going to play real estate trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
As I speak, inflation is robbing you at a rate north of 10%. Last year, the number one zip code that Mid-South homebuyers offered income property to Real Estate Guys listeners in appreciated by 21%. To harness that spread and protect and grow your wealth in the current economic storm, you need the 2 decades of experience in renovation and management that Mid-South homebuyers brings to their investors. Every home Mid-South offers you will have brand new components, a new 30-year roof, and a high-quality renter, all in a price range under $150,000. Their empathetic property managers will use your ROI as their North Star, while the lack of repairs on their totally renovated properties contributes to their almost 4-year average renter stay and 99% occupancy rate. Learn about their lifetime occupancy guarantee and total 1-year maintenance guarantee by emailing midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com. You'll be glad you did.
Hey everybody, it's Ken McElroy and I'm on with the Real Estate Guys, and I'm very excited to be a guest and a speaker at the Investor Summit coming up. If you haven't signed up, be sure to do so.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Hey, if you want to achieve more in the new year and really pour it in all areas of your life, then come on out to Create Your Future, the 2024 Goals Retreat. It takes place in Dallas, Texas, the second weekend of the new year. It'll change your life. You can get the details at goalsretreat.com. That's goalsretreat.com. We're talking about alternative lending options when interest rates are high. We've got some more ideas for you, but first, it's time to play Real Estate Trivia. That's your chance to win a prize by knowing today's real estate trivia question. Just a minute, I'll ask you a question that has something to do with real estate. As soon as you think you know the answer, send your best guess to trivia@realestateguysradio.com. Give us your name, the answer to the question, and your physical mailing address, because if you're the first to get it right, you're going to get an awesome book by our friend Ken McElroy called The ABCs of Buying Rental Property. That can be yours if you know today's real estate trivia question. Last week on the show, we had Brent Johnson talking about the strength of the U.S. dollar and what it means for real estate investors. We asked this: in what year was the first paper currency in the U.S. born? It was the year 1690. According to the U.S. Currency Education Program, colonial notes were first issued in 1690 by the Massachusetts Bay Colony in order to fund military expeditions. Who knew? Here's our real estate trivia question for this week. Name the U.S. state with the lowest cost of living as of last year. Yeah, of all the U.S. states, where is it the cheapest to live? If you know, just want to guess, or maybe you live there, send your best guess to trivia@realestateguysradio.com, trivia@realestateguysradio.com. Give us your name, your guess, and your physical mailing address. Because if you're the first to get it right, you'll get the ABCs of Buying Rental Property by Ken McElroy. That's today's real estate trivia question. It's tough out there and financing is expensive, so we're talking today about alternative lending options when interest rates are high. We've covered lots of them. The next one applies under a certain circumstance, so we'll throw it out there and see if this works for you. But if you already own several properties, there's an excellent chance that you have or could get a line of credit against the property. Whether it's a home equity line of credit or it's just a line of credit extended to you by a bank, that's a way you can get your hands on some capital that isn't liquid cash. Russ talked about before the break the reasons you want to get rid of cash. Kiyosaki says cash is trash. Use that cash buying a productive asset instead of watching it dwindle away further. But the same thing could be true for a line of credit. It may be you can become a cash purchaser by using a line of credit, or a line of credit is essentially a loan and you use the money to buy a property for cash, but it feels as though you were financing the property.
Well, if you've got a good property that's got good equity and you've got a line of credit on it and that property is already at the upper end of its condition, in other words, it doesn't need a lot of work, it's going to appraise well, you're going to get a good interest rate, all of that relative to what's available in the market, you can use that line of credit to go purchase a property that would otherwise be difficult to finance because it isn't in great condition. It has some work that needs to be done. And you can see the potential and you can unlock the potential, but you need liquidity to do that. And so I think people have been doing this for a long time. The danger, and I just speak from experience, is that when you've got properties with lines of credit or any lines of credit, the challenge is when lending gets difficult and credit goes risk off, those lines of credit can be shut off without warning. So don't ever get into a deal counting on a line of credit, thinking that it'll be there when you need it. And certainly don't operate your business like I did. I had no cash in the bank. I had lines of credit when they inexplicably, without justification, other than they just decided they didn't want to take risk. I hadn't missed any payments. It was no problem. They started shutting those lines of credit off and I became illiquid very, very quickly. So I'm a big fan. If you have a line of credit, draw it. That way you have it. If you go back in the history books and read about the way two major companies, Ford Motor Company and General Motors, both handled their balance sheets as the storm clouds were forming in the 2008 great financial crisis. Ford saw it coming and drew down their line of credit, I think to the tune of like $1 billion, almost $2 billion, $1.5 billion, and GM did not. And so what ended up happening is credit all dried up. Ford was very liquid. GM was not. GM was going broke and needed to be bailed out by the government. And had the government not stepped in and bailed out GM, I'm pretty sure Ford would have been able to use that credit line, that cash they had, that dry powder that they had the foresight to arrange when the credit was good, and acquire the assets of GM for pennies on the dollar. But the government intervened and that didn't happen. And, you can argue whether that was right or wrong or good or bad. But the point is, I'd much rather be Ford and see the problem coming and get liquid in advance. And I think that anybody paying attention right now realizes credit markets are still fairly fragile. It could get worse before it gets better. So if you do have lines of credit, think about drawing on them. I'm not saying go spend the money, just to be liquid, so that if there is distress in the marketplace, you can use the proceeds from those lines of credit to step in and acquire assets the way that Ford might have acquired GM had the cards been able to play out in a free market.
If you have a line of credit and you're not using it, it could be shut off. But once you've borrowed the money, then you have the money. Now, I will say, earlier I said, if you have a line of credit or could get one, I think we should probably say that Russ isn't a fan of lines of credit necessarily. And there's a couple of quick reasons you should probably cover.
Yeah, I think one of them is they are typically short-term loans. Number two is the rates are often adjustable. And in an environment where, you're trying to fix your cost of capital and you got an adjustable rate loan, you may not be willing to take that risk. But you don't have to decide that at the time you draw it. You have to think about that at the time you deploy it.
Right.
One of the mistakes that's easy to make is to borrow short and invest or lend long. And that's a bad mix. Banks do it all the time. That's their business model. That's why banks continually get in trouble, why we had to create a Federal Reserve to be the lender of last resort, and you see bank bailouts. Their business model is flawed. They borrow from their depositors short-term demand deposits. You can put $1 million in the bank this morning and come back that afternoon and take it all out. In between, they may have made a 30-year mortgage on it, and now the bank has a liquidity problem. Banks can play that game, but you shouldn't. So just be careful when you're using lines of credit. Understand your underlying loan terms before you deploy that capital. Make sure you got a good balance.
And also talk to your loan professional, because even an undrawn line of credit can count against your qualification as you're borrowing for all kinds of things. But if you have a line of credit, could be a way to use it. All right, that's number 5. Number 6, this is also one that applies to certain people. We have a lot of folks in our listening audience that are Fannie and Freddie'd out, which means that they already have 4 or 8 or 10 loans on single family or 1 to 4 unit properties. And therefore getting that 11th loan is not only hard, sometimes it's more expensive. Usually your 5th loan is more expensive than your 4th loan, which means that it exacerbates the problem with interest rates being high today. And now you're being penalized because you're an investor and you're buying your 5th or 11th or 23rd property. Well, one option would be to consolidate that financing. You can get a blanket encumbrance. I could take, say, 8 single-family homes that have good rental history, that I've owned for a while. They even have some equity. And there are lenders that'll come in and make me one single loan against those properties. And the reason I would do that in the context of this discussion is now I will have available to me the lower rate, better term loans, even though they're not great, better than what an investor would pay.
Well, and think about this. If you are a community lender out there, a small bank, or other lenders that specialize in those small commercial properties, and you're looking at the potential train wreck in small commercial right now, you may be looking for a way to make loans on better assets, and a portfolio of single-family homes or residential 1 to 4 could be a great portfolio to make a loan against. So instead of getting a loan against an individual property, the commercial bank comes in and says, okay, I'll take that portfolio of 10 properties, pull the equity, pull the income, and make one blanket loan, pay off all those underlying Fannie Freddie loans, and that, to your point, Robert, frees you up to be able to go add more, getting that long-term Fannie Freddie financing. The lender realizes, just as you do, that should anything begin to happen, you can begin to peel off those properties one at a time. You need to make sure in that deal you have a partial release clause so that if you sell a property, they will release the encumbrance as long as they get paid a proportional rate of the loan off. Otherwise, you end up with a bunch of properties you can't sell or refinance, and that can become problematic. But I do think that there may be an appetite for this with these small community lenders that are feeling a little nervous about commercial properties and would like to have better quality assets. And I think you could make the argument that residential would be on that list of better quality assets.
Interest rates are high today, so we're talking about alternative lending options. We've got a few more when we come back. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
Hi, this is Garrett Sutton, Robert Kiyosaki's asset protection attorney and the author of Loopholes of Real Estate and Start Your Own Corporation. As an American or foreign-based investor in U.S. real estate, you know we are a litigious society. You know that you need to protect your real estate, paper, and bullion holdings with the right mix of LLCs and corporations. Our firm, Corporate Direct, not only forms these entities, but importantly, we properly maintain them too. If you fail to follow the corporate formalities, you can lose it all in an instant. Corporate Direct is your source for LLC protection and maintenance in all 50 states. Visit corporatedirect.com or call 800-600-1760. Mention the Real Estate Guys for a free bonus. That's 800-600-1760 or corporatedirect.com. We look forward to assisting you at corporatedirect.com.
Having trouble finding deals where the numbers make sense? Invest in an asset class that delivers cash flow to you in good times and bad, and where most of that cash flow is tax-free. I'm Dave Zook. Many of you have heard me speak at Real Estate Guys events or heard me on their podcast. My team is a top 5 ATM operator in the country, and right now accredited investors can make cash flow returns well into the double digits and get huge tax deductions. For your free report on this lucrative asset class, email atm@realestateguysradio.com.
Hi, I'm Aaron Katusa, the chairman of Katusa Research. You're listening to The Real Estate Guys.
And welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Hey, coming up in March in Dallas, Texas, it's the secrets of successful syndication, a way that you can put together money to do bigger deals or passively invest in awesome real estate projects. If you'd like more information, check it out, our website at realestateguysradio.com under the tab that says Events, where you'll find the Real Estate Guys events and all the places that we show up at other people's events. We're talking about alternative lending options in a high interest rate environment. We've covered 6 so far and a couple of bonus ones in there. Number 7 is a great source of capital, which could make you a cash buyer or could give you substantial down payment and get a loan, and that is using your retirement account. There are trillions of dollars in retirement accounts, not all of it available for this purpose, but a bunch of it is. If you have a self-directed IRA, there's definitely money that you can put to work buying property, and there's some real advantages to doing so.
Yeah, we're probably overdue just to do a show on this topic because there's certainly some nuances. Tom Wheelwright, our good friend CPA, is not a big fan of holding real estate, title to real estate inside of an IRA or any type of a tax advantage fund like that because one of the great benefits of real estate is the tax benefits and you don't get them. And then it converts your capital gains into ordinary income. So there's some disadvantages in doing it that way, but you can make loans. You can invest in an LLC, a private LLC, and then purchase the property. So there's some things that you can do. But the point is there are trillions of dollars in retirement accounts. And when someone leaves a company and their 401k is no longer captive, it rolls over into an individually controlled 401k. You can either, if they become self-employed, they can have it in a 401k or they can put it in a self-directed IRA. And you can pool that money with other people's IRAs. So it can behave a lot like an individual. There are some prohibited people. You can't invest, do business with yourself. You can't invest with your children or your parents or grandparents. You can do it with your siblings or strangers and people you choose as partners. Again, we're not giving you tax advice. These are just ideas and strategies. Make sure you check with your qualified advisors before you do anything. But it is a big pool of capital that's out there. And once you learn how to use it properly and take into consideration the rules and the tax consequences, then you can tap into that either on the debt side or the equity side, either owning the property directly or through an entity like an LLC.
Back in the day, and when I say back in the day, I mean about 20 years ago, Russ and I would often sit down in a consultation with folks, and this was one of the areas that people had on their balance sheet and didn't even realize. They didn't know they could access this capital. People think about their retirement funds as, oh, someday when I retire. But if you will just manage that actively, it's amazing what can happen. So it may work, it may not for you. That's number 7. Number 8. Let's talk about other assets you may have that could be used creatively to help you acquire real estate today. One I know that is near and dear to your heart, Russ, and that's the precious metals.
Yes, I love precious metals because I think it's a great alternative to cash. in terms of having something that's pretty liquid. It insulates you from the financial system because you're no longer in the currency and you're no longer in the banking system. It sits on your balance sheet like equity, if you will. And people say, well, yeah, but it doesn't produce any income. It doesn't produce any tax breaks. It just sits there. Yes, it does. But what it is it's an asset you can borrow against. And so you can retain all of the quote unquote upside of the precious metals in terms of dollars. So if gold goes from, say, $1,000 an ounce to $2,000 an ounce, you get to keep all of that upside potential. But during that time, you could take out a loan against it. And it's much like getting an asset-backed loan for real estate. It's just asset-backed by precious metals. And then you can take the proceeds of that loan and invest it in something like real estate, pick up some tax breaks, pick up a stream of income. And it's just another way to find liquidity and maybe find an asset that there would be a greater market to lend against. We've got a friend, Rick Rule, who is working with another gentleman, Frank Trotter, to put together a new bank called Battle Bank. And we've been watching this go on. It's a long, arduous process of clearing all the regulatory hurdles. But we talked to Rick at the New Orleans Investment Conference, and they're getting close. And because Rick is a really well-known resource guy and really gets gold, they are not afraid in any way, shape, or form of making asset-backed loans against precious metals portfolios. And so very anxious to see that. There's other lenders out there that do it now. I can't tell you the rates are great, but I think that the product that Frank and Rick are going to come up with are going to be very friendly to precious metals owners, and I think also for real estate investors. So we'll keep you posted on that. Stay tuned.
So as we say in radio, exactly, stay tuned. So there were a couple more we had in there, but because we're getting near the end of the show, we're going to end with maybe one of our favorites, and that is, if you need capital, why not raise it? Rather than borrow the money, one way to get the lion's share of the value of the property, you could raise capital through a private placement or a syndication.
We've been talking about this since forever. Back in 2011, in the wake of the 2008 financial crisis, the distribution system of money to market was broken. I was in that distribution system in the mortgage business. When everything fell apart, it was like somebody tripped over the cord to the jump house, pumping all the air into the asset values of real estate and stocks. And when that happened, all the prices dropped. That was severe asset price deflation. If you were sitting on cash, it was a wonderful time to be a borrower. If you were not in cash and you were dependent upon healthy credit markets, you were locked out. And that's the position I found myself in. So when I looked at that, I said, well, knowing what I know now, where's the big opportunity? And the opportunity is there were still a lot of people out there that had built great businesses and they were exiting and they had cash. People who had seen what was coming in the stock market or even in real estate had cashed out. People that just had very productive businesses and were just stacking up profits. And of course, what got us into the gold space was people who had invested in gold at the beginning of the 2000s at $200, $250 an ounce. We're now seeing gold at $1,900 an ounce. And they had all kinds of deployable capital. And so they didn't want to get their hands dirty doing real estate. And the big opportunity was to come in and aggregate that capital from people who had it and bring the hustle and the deal flow and the oversight and go find the deal and put it together and share the profits. And that's all syndication is. And that whole thing turned into this giant movement we've been at the forefront of for the last decade. Every time we do the Secrets of Successful Syndication seminar, we say, boy, it's just never gotten better. It's so good, you know, and it is always for different reasons. And right now, I think there are some storm clouds forming in the real estate pricing world. If we get a big influx of inventory, if interest rates were to go up further, there's going to be some distress. Some people can hold their breath for so long, and at some point they got to unload their properties. You've got baby boomers who need to move and people who are selling their businesses and exiting properties. So there's going to be some movement. The people that can move quickly with cash are going to be able to have opportunities. So really now is the time to be building those relationships, getting yourself organized, getting both in the flow of investors and building your brand and building your network so people know you, like you, trust you, and are willing to invest through you, with you, and through you. And then also building up your network for the same thing for people who are going to bring you deals. You don't want to do it when everything breaks loose and now's the time. You're like, well, now's the time, but I'm not ready. Now's the time to get ready. And so we got this event coming up in March. It's going to be super exciting. We get some new speakers we haven't had before. Very excited about that. If you're interested in attending, you want to get all the details, just send an email to syndication@realestateguysradio.com. And you can raise both equity, which would be down payment money. You can raise debt, and you can raise both in the same deal from two different groups of investors.
You know, if we're complaining that interest is too high, well, then why not make some of it? You could raise capital to go make these kind of loans. So it's a big topic. We'll spend 2 days and over a dozen speakers talking about it. Come on out to the Secrets of Successful Syndication. Just send that email to syndication@realestateguysradio.com. The big message is don't get discouraged just because rates are quote unquote high. They've been higher before. They might be higher again. But if you are tuned in, paying attention, strategic and intentional, the more difficult it gets, the less competition there is. So we wish you happy and healthy investing. Next week on the show, we'll talk specifically with a builder-developer who provides inventory in a landlord-friendly environment for folks like you and has a great interest rate using one of these strategies. Until then, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors. From attorney and rich dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys radio show.